Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Tuesday afternoon, we have Shawn, Cruz, manager of trader services at TD Ameritrade, to discuss Nasdaq-100 performance trends in the Nasdaq Volatility Index, or what we call VOLQ. We'll also take a look at rates. Shawn, it's great to see you as always. Welcome back to Trade Talks. And let's get an overview of levels that you're watching in the Nasdaq-100 and the Nasdaq-100 Volatility Index.
Yeah, so if you look at where we've come so far, just looking back over the past year, there's been a little bit of pullback, a little bit of a relief rally more recently that certainly has translated into a little bit more volatility as of late. So I don't know that we're necessarily going to come back and maybe test some of those June lows, but I think after this pullback, I would look for some choppy trading where you get moves that are a little bit more the magnitude of say, 1 to maybe even as much as 1.5% in either direction on any given day. I think if you look at VOLQ and some of the levels that VOLQ has now moved back up to, it's almost telling you to expect those types of moves on any given day. So although it's elevated, it doesn't necessarily just mean you should expect massive volatility in terms of just gaps lower down day after day after day. I think what it tells you is that the forward-looking expectations for volatility are expecting a pretty decent range for the index to trade in on any given day.
And if we take a look at the heat map, kind of a lot of red here as we round out August.
Yeah, and I think this is something where this just lets you know there's just some broad-based selling, a little bit more of risk aversion is getting placed back into the markets here. So it's not like you're seeing this focused in any one company, any one sector. I think it might actually be a pretty good sign that despite seeing a sea of red here, you're not seeing the index make a massive move lower. So I think this is probably just some repositioning, given a lot of the talks that we've heard from the Fed, a lot of the rhetoric we're hearing out of them, just regarding their approach to policy and how much pain they're willing to take here domestically in terms of economic growth to get their goal of reining in inflation achieved. But also think about what's going on around the globe as well. A lot of these big tech companies that you're seeing here have a massive global footprint. We got more bad data out of the EU overnight. We're also continuing to get negative headlines coming out of China. So I think it makes sense that these massive companies with a lot of growth priced in are going to be struggling here a little bit.
And finally, Shawn, let's wrap up with rates. I mean, August, obviously a big month for anyone who's rate watching the market overall, where we went through Jackson Hole. Powell finally made his comments at the conference, and really not much has changed in terms of his tenure.
Yeah, and I think that is one thing that is particularly noteworthy that we're seeing out of these markets is that the 10-year yield didn't really move much when you saw this massive run up in markets, sell up in markets, presumably because of what the Fed had signaled and what some of the incoming data haven't been able to cool off the labor market with everything they've been doing. Are they going to have to get even more aggressive in terms of reining things in? But this tells you that the fixed income market wasn't nearly caught off guard as much as equity markets had been. And if you look at this move higher, this steady march higher in yields, the market more or less didn't really react to that as strongly. And certainly that showed up in that massive one-day move we had, where treasury yields didn't really have budged too much off those levels, just above 3%. But we certainly saw a pullback out of equity. So I think that really does, to me, indicate that fixed income markets were a little bit more prepared for what we were going to hear, what we have heard from the Fed and a hawkish Fed moving forward than maybe equity markets had been. And so I think as equity markets now need to maybe reprice for a little bit of a change in these outlooks, that's going to be a driver of volatility, but it's also probably going to lead to some pretty decent volumes as you do start to see a lot of repositioning being done across the board, because clearly by and large investors of almost any class past here, whether you're talking about individuals or institutions, we're not ready for what we heard from the Fed. And there's probably going to be some repositioning as we head into September, because we now have a pretty big September meeting coming up. And I think a lot of the data, especially the data we get this week, is going to be a little bit more of a driver of volatility as we try and dissect what we hear from just getting jolts today. We get ADP, then we get the big jobs report later this week. Items like that are really going to be digested with the thought process of what does this mean for the Fed, or what does this mean in terms of the Fed making progress on what their stated goal was to calm things down. So certainly going to be a lot of volumes, I think, increasing, and also some elevated levels of volatility like we've been seeing so far this week.
All right, Shawn, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.